And well, here we are, episode 23, Terry. And guess where we're coming at you from? We're coming at you from Las Vegas, Nevada. And super excited today. We're doing a little twist, Terry. And I know you and I went and visited Terry down in Florida, and we were talking about this topic. And we have an expert. We got Rick Rodriguez. We're talking about reverse mortgages and all of the myths and all the real true facts about reverse mortgages. We're going to talk a little bit about Las Vegas. So, hello, gentlemen. Hello, Terry. You're muted there,
How we
buddy.
doing?
I knew I was muted. I was just a test. Yeah, hello, David. Rick, it's great to see you guys. 74 degrees today in Orlando. 74 degrees. It's a beautiful day. It's been a beautiful week. I'm telling you, it's a great time of year.
We got 67 degrees here in Las Vegas.
Not bad.
And we've been traveling all over the country, Rick. We go to a different city just about every week, every Monday. And so it's nice to have somebody here in my backyard so we can gang up on Terry and all his. Florida is a great place, though, Terry. I give you that. So, Rick, thanks for joining us today.
Yeah, well, thanks for having me. I'm very happy to be here, part of the show. So, looking to add my insights however I can.
Well, super. And just to give everybody that's watching, all of our members from Leaving California, I actually took a class with Rick, and I was so impressed. I called Terry right away, and I said, Terry, we've got to get Rick on here. And I learned it was a really educational class, and I was just hoping that we could actually share some thoughts. I know there's a lot of myths, and you busted a lot of the myths about reverse mortgages. And it was interesting how you said, 15, 20 years ago, some of these myths are true, but times have changed. Terry, what do you know about reverse mortgages?
Well, I know back when I was in the mortgage business 20 years ago, they were really hitting their heyday at that time. Again, as you said, there was a lot of issues with reverse mortgages, and it sounds like they've kind of corrected those. So I would love for people, and I didn't know about the changes, so I would love for people like Rick to tell us, someone like Rick to tell us why people should consider a reverse mortgage, the benefits, and then also dispel those pitfalls that were associated with it. For example, I heard that people at some point would get thrown out of their house because they hit a negative equity and stuff like that. If you can, that's the kind of thing I want to address today so that we can re-educate people on why they should think about a reverse mortgage. Probably not right for everybody, but certainly for those, some people, I'm sure it's a good fit.
So without further ado, I'd like to introduce Rick Rodriguez from Las Vegas. If you want to tell us a little bit about how long you've been in Vegas, tell us about your craft and what you do. Take it away, Rick.
Yeah, well, thank you, gentlemen. I'm one of those rare breeds, born and raised here in Vegas at my age. I've been in the mortgage industry 2003. I stumbled into it. I was actually working for a public accounting firm. I had an accounting degree here at UNLV. And a good friend of mine said, hey, you should think about the mortgage industry. This is 2003. Things were going well. 2004, I get a phone call. Gentleman says, do you guys do reverse mortgages? I said, sir, I've never done one, but I'll be happy to look into it if you allow me the time. He said, sure, kid, go ahead. So that was about a 4-month project. The gentleman was in bankruptcy. He was on the verge of losing his house. He was behind on credit cards. He was actually immobile. He was in a wheelchair. And I embarked on this project, which took me to the Clark County Court office multiple times to file a motion of what's called a bankruptcy buyout. And I won't give you all the details, but I did complete the transaction for him. I did save his house. I did pay off his bankruptcy. I helped him eliminate all his credit card debt. I mean, changed the gentleman's life. And when I stepped back and I looked at what I did, I told myself, I think I found out what I want to do. And this is it. And so I went back to my superiors. I said, I want to start just specializing in this product, learning about this product. Because at that time, I was very new. I only had research and information that was available at the time about what a reverse mortgage was. And of course, there was a lot of skepticism in 2004 at that time about what the product was. So I myself was skeptical, but I wanted to see firsthand, is this a good product? Is this something that I can bring value to my clients? So I've had a front row seat now for 20 years. I can't tell you how many thousands of people I've put in a reverse mortgage, including family members, including friends. And what I can tell you, number one, is that what I true heartedly believe is that anyone over the age of 62 who's a homeowner should at the very least look into this product, at the very least. See what the numbers tell them. See if it's something like any financial tool, if it's going to work well for them or not. That's the first thing that I would advise anyone. Secondly, what I can tell you is that I've seen this product work on all ends of the spectrum, from those who are in need, which has been the stigma of this product. Only take out a reverse mortgage when you're in need. And frankly, that's been the majority of the transactions since its inception, is it's helped people in need. However, let's not pigeonhole this product to only those in need, because this product is being used by people in the middle class who don't have a need but have a desire to get further ahead in their retirement, whatever that looks like for them. And I even have clients all the way on the other end of the spectrum, affluent borrowers who don't need money. They've got plenty of money. However, they understand the power of leverage and how this tool can leverage against their housing wealth to further create wealth for themselves. And for many people, that seems just contrary to the notion of what a reverse mortgage is. They never think that this could be used to actually create more wealth. One of the big stigmas is this product is here to steal from your personal wealth or steal from your beneficiaries' wealth. You know, how many times I've heard it, shame on you. You guys must not like the beneficiaries, you that handle reverse mortgages. Just the kids must just be chopped liver. But to the contrary, there's been a lot of research outside of my industry by some of the most prominent retirement income researchers today. I'm going to throw out a couple names. Wade Pfau is one of them. That last name is Pfau. Jamie Hopkins and Barry Sachs. These are three certified financial planners, attorneys combined, who have done a lot of research. And that research has helped to bridge our industry with the financial planning community. And what it's come to now is that this has become a financial planning tool to help people increase liquidity, further grow assets, and in many cases, decrease income taxes. And when you talk about those 3 points, I think you get anybody's attention. Show me how I can increase liquidity in my life. Show me how I can further grow my nest egg. And yeah, tell me how I can pay less in income taxes, right? So this is what the research has shown. We obviously, there's too much to unpack here on one podcast, but there's a lot of information out there that I can always point individuals to. But that's what I like to lead with is get people to have what we call a paradigm shift in how they look at real estate and mortgages when you get older in life. And that's really what a reverse mortgage requires. It really requires you to take a pause and a step back from how we've been taught since we were yay big about mortgages and real estate, to understand that life changes as we get older. The way we look at life changes. Shouldn't we look at our mortgages and real estate in a different manner as well?
Rick, you had mentioned something in the class, and it really resounds with me. It was that, sometimes you're able to help your clients be able to provide for their beneficiaries while they're living. And you don't want to wait until you pass on and then having to try to figure it out. That was something that really kind of caught my attention. Can you elaborate a little bit on that?
Yeah, I once heard someone say, and some of the things I deal with are a little morbid, so you got to take it with a grain of salt. But I heard one person once tell me, "Isn't it better to give with a warm hand instead of a cold hand?" And that resonated with me. I thought about myself, in my family, my children, and would I rather, number one, help them perhaps in times of need when they actually need help, which could be today while I'm alive and well. And secondly, if I had the choice, would I rather help them when I'm able to see what that could do for them while I'm alive and well, to actually see the benefit of the help that I can give them? And that is one of the many different reasons that someone may turn to reverse mortgage, is perhaps they want to drip their inheritance while they're alive and they're able to, and again, help their family today while they need the help. So there's a lot of individuals, clients of mine personally, who that's been their main objective is I want to take out a reverse mortgage because I want to help family today.
Terry, do you got any thoughts going on in your head back there?
Sure. Rick, can you just start with the basics? There may be some people on here who have never heard of reverse mortgage. Can you tell us exactly what it is and just kind of the life cycle of it, what happens at the end of the reverse mortgage, if there is one, how all that works, just the overview?
Yeah, absolutely. So today there's two types of reverse mortgages. There is a proprietary, in other words, private reverse mortgage that was created about 8-10 years ago that fulfill a certain void. And then you have the most common reverse mortgage, which is called the home equity conversion mortgage. That is the one that you see in commercials, you see on the internet, that's more readily available and utilized. That is the one that is also insured by the Federal Housing Administration. And it's been such since 1989. That's when then President Reagan signed this bill into law to start federally insuring reverse mortgages. And since then, that was the biggest change to reverse mortgages as a whole, because prior to that, reverse mortgages were all privately funded, not insured by the Federal Housing Administration, and they worked completely different. Back then, pre-1989, that's where a lender would take title to the home. That's also where the lender would share in on the ongoing appreciation of the home. Since 1989, that hasn't been the case. However, you still read that. You still read that on Facebook and different social media posts. There's still a lot of individuals that believe that the bank takes title to the home, which, by the way, that is misconception number one as of today. Still, people believe that that is the case, and this is what's keeping people from looking into a reverse mortgage, whether it's the private or the home equity conversion mortgage. Neither one of them takes title to the home. So the home equity conversion mortgage, the FHA reverse mortgage, again, the most common one, in order to qualify, you have to be at least 62 years of age or older. And if you're married, as long as one of the spouses is 62 or older, the younger spouse will now be placed on the reverse mortgage and equally protected. This was a huge change that took place almost 10 years ago. And this is what corrected the biggest black eye on the industry, which was prior to that change, an older spouse could take out a reverse mortgage without the younger spouse being on the loan. They could, they would have the older spouse would have the reverse mortgage for years. Then the day came when that older spouse passed away. And now that loan was due in full, even though the spouse, the surviving spouse, might have been on title. That's fine. Those are title rights, which just means that upon the passing of the older spouse, the younger spouse does get title to the home. But now we've got a lien against the house. How is that younger spouse going to contend with it? And as you can imagine, these were many of the horror stories throughout America. And what you would read on the New York Times, they would catch the article and all it would say on the headline was, "Widow kicked out of home by reverse mortgage bank." And the New York Times, they didn't even understand the product. They didn't have the complete story straight, but it didn't matter because the headline did all the damage. And so our industry got proactive and said, okay, from now on, there's no more of that. Consumers are not going to have the option of just putting an older spouse on a reverse mortgage. So from now on, for the last 10 years, if you are legally married at the time of applying for a reverse mortgage and your spouse is not of age, that younger spouse is going to go on the reverse mortgage. That is now a requirement. They no longer have the option, unless in some extreme exceptions where they're in the process of divorce or they're legally separated and they can demonstrate that. But if they are married, living together, the younger spouse, even if they're not 62, is going on the loan. So that protected the consumer. And again, it rectified the biggest black eye that we had on the product.
So, Rick, does that mean that if I go find myself a 25-year-old wife, I might be able to entice her to marry me?
Terry, that's a good question. Because I always kind of joke around in my class and say, listen, as long as they're legal age, please, 18 or older, right? So 25 is perfectly fine. But
Well,
yeah.
So Rick, when I came and took your class, I did have the misconceptions. So let's kind of start there, and maybe we could. I know we only have like 45 minutes to an hour, but this could go on for a long time. What are some of the big misconceptions? I'm sure that a lot of our members from Leaving California, and by the way, we have a lot of baby boomers that are in our groups. Terry's done an amazing job getting us up to almost 300,000 members, and so for them listening in, maybe we could talk about cost. Is this an expensive product? And what are the maybe two or three of the misconceptions that people have? Should we go with cost first or the misconceptions?
Well, why don't I continue with the misconception? So we talked about misconception number one, the biggest one, which is, again, and I need to reiterate, you are the title holder. The bank does not take title to the home. This is just a mortgage lien against the property, period. Like any other mortgage lien you've ever had against your home, it's recorded in the exact same section of the title report, and it doesn't impede on title rights in any way, shape, or form. You are the title holder. You are the decision maker. If you wanted to pay off your reverse mortgage at any point in time, you can do so. There's no restriction. There's no prepayment penalty. And then upon your passing, if you are going to leave the house to a beneficiary, we always recommend a living trust. That's the sure, fast way to transfer title. That individual is going to get the title of the home, and there's a lien that they have to contend with. Like any other transfer of real estate that has a lien on it, you're going to have to contend with it. You're either going to have to pay it off if you want to retain the property, or if you're not going to retain the property, it works the same process as any other home sale with a mortgage. You put the house on the market, the reverse mortgage gets paid off at that time, and the remaining net gain or equity of the home goes 100% to the beneficiary. Okay, so that's, again, buttoning up misconception number one. Misconception number two is the equity. A lot feel that the bank takes equity to the home, and that is false. This is just a mortgage that the bank is only entitled to whatever the mortgage balance is over time. Now, the big difference of this mortgage from any other mortgage is that it's an optional payment mortgage. And that's the simplest way for one to understand what exactly is a reverse mortgage. And that is, it's an optional payment mortgage. So, and this is one of the many reasons that I love the product personally, is that I like to have control over my money. I like to be able to decide at any point in time, where does it make most sense for me to place my money? Should I pay a mortgage company? Should I retain the money? Should I send the money to my financial advisor instead? I like to have those options. And this is what the reverse mortgage provides. And this is where the research shows that it can really catapult one's wealth when you have these types of options to best strategize where to put your money. So with the optional payment feature, if one doesn't make a payment, what's happening over time is that the balance is rising. Hence the word reverse, right? Traditional mortgage, you're required to make a payment every month. Therefore, the balance is coming down little by little, month by month. With the reverse mortgage, if you elect not to make a payment, which is perfectly fine, you can elect not to make a payment for the rest of your life. There's a couple qualifying terms that we'll go over here in a second, but you can decide never to make a payment. What's going to happen then is the balance in the end is going to be larger than what you started with. So when the beneficiaries take over, whatever's owed at that time gets paid in full. And the way it's forecasted is that there should always be a sizable amount of home equity still left behind. As long as real estate does what it historically does, 4% national average is what our industry uses. So that combats misconception number two, is that the home equity is still yours. The transfer of the title is also what you can transfer easily. Many people don't think that. And then closing costs. Yeah, one of the big misconceptions is that you only do this product when you're in need, because boy, this product is going to rob you. So if you've got no other options, then and only then break the emergency glass, which is the reverse mortgage. And initially, the cost of setting up this product, hands down, more expensive than any other mortgage in America, period. Why? Well, it's an expensive product, but it has benefits and luxuries that are way superior than any other mortgage in America. And so therefore, there's going to be a cost to that. And the biggest cost is setting it up. What really sets and I'm talking about closing costs, when you first either buy a home or you're going to refinance your home with a reverse mortgage, the initial one-time costs. And what makes that more expensive is the initial insurance that has to be charged on the home equity conversion mortgage, the most common reverse mortgage. And that is today 2% of whatever your home appraises for. So you got a home of 800,000, 2%, 16,000. That goes to the insurance pool, FHA's insurance pool. It doesn't go to the lender. And that cost by itself is what makes the closing cost of this product more expensive than any other loan. However, that insurance is the glue that holds this product together, that provides all the benefits that other products do not have, such as the optional payment feature and the non-recourse feature, which is if one ever ended up owing more on their home, the balance that is, than what the value of the home is, that insurance protects them 100%. It allows them to continue living in that home with the optional payment feature for the rest of their life. And upon their passing, if the home is still upside down, that insurance covers any deficiency 100% that the value of the home cannot cover. So that's a big deal. If this would have been around for people in the 2008 crash, more people, in my opinion, would have stayed put in their homes if they had a reverse mortgage, assuming they loved their home, right? It wasn't a matter that they didn't like their home. They were just concerned about their equity position. If they would have had a reverse mortgage in place, they would have just kept living in their home for the rest of their life. And even though they were upside down, it made absolutely no impact to themselves. So that's a big part of the insurance. And then lastly, what the insurance does, and this to me is probably the most important thing of the entire reverse mortgage. It's what 10 out of 10 people do not know about the reverse mortgage, and that is the growing line of credit. That within the reverse mortgage, there is a line of credit feature that allows you to hold funds. Like, for example, if you're going to refinance your existing home, you're going to qualify for funds, you can have those funds held in a reverse mortgage line of credit. Or if you buy a house, any payments that you make afterwards would go into this line of credit. So it works like a home equity line of credit. However, what makes it superior is that any funds you keep in a line of credit will grow at the exact same interest rate as the loan balance. And this is insured and guaranteed because of this costly insurance that I'm speaking of, a part of the closing costs. This is one of the benefits, luxuries of this product that the insurance provides. And that is a whole other hour of a podcast that we can't get into, but I just wanted to tease the audience, let everyone know about the growing line of credit. And of course the insurance, how that insures it. Going back to your question, David, as far as the closing costs, that's what makes this a little bit more expensive. But again, there's value behind the cost.
And so for our members, just so they have a little better idea, do they have out-of-pocket expenses, or is it typically, and maybe I guess you talked about that in your class where you had to have a certain amount of equity in your home, and then out-of-pocket expenses. Can you touch on that?
Yeah, when refinancing a home with a reverse mortgage, the two only and most common out-of-pocket expenses are counseling. So many people don't know that when you apply for a reverse mortgage, the product, that's part of his protective measures, wants to make sure that the applicant is fully comprehending what a reverse mortgage is, how it works. So it requires the applicant to go through a third-party counseling session with various agencies throughout the country and spend about an hour. Most people do it over the telephone. It's just a one-time thing over the phone, and spend about an hour so that the counselor and the applicant, the consumer, can engage in answer any questions that the consumer might have. For the consumer, it's a great step because it gives them another voice, another source that they can go to before anything starts. And by the way, this has to be done in the beginning before the reverse mortgage bank can start the process. It's intentionally done so that the consumer can get all their questions answered, get all the information rehashed once again, and walk out of that session feeling 110% sure about what they're doing, right? So that step there, on average, ranges anywhere from about $150 to $200 is what counseling agencies charge. That's something that the consumer pays directly to the counseling agency at the time of service. And then on a refinance, the only other cost that would come into play out of pocket would be an appraisal. So when the appraiser comes out to the home, the consumer has to be prepared to also pay the appraiser directly. Depending on what location you're in, appraisals can range and vary anywhere from like $600 to $800, depending where you're located. All the other costs of setting up the reverse mortgage on a refinance are financed into the costs. Now, on a purchase, you are bringing that, as any purchase, closing costs, you're bringing that to the table at closing. There was a huge change that just took place a couple months ago, in that now on a purchase transaction, you can, oh, what am I speaking of? People are saying purchase transaction, Rick, what are you talking about? Well, I'm talking about a niche within the niche, and that is, yes, you can use a reverse mortgage to buy a home, which is another 1-hour podcast that we can't get into all the details, but just so you know, you can use a reverse mortgage to buy a home, and there's all different sorts of advantages on why that makes a great deal of sense for someone. In that scenario, you're going to have closing costs like any buyer, and those costs, you do have to bring that in addition to your down payment. But there was a huge change just took place in that now this product allows for seller credits towards buyers' closing costs, which are in line with traditional mortgages and how they operate on a purchase side. So that just literally happened in the last couple of months. So that helps buyers now minimize their costs when buying a home with a reverse mortgage.
Rick, I'm going to have to slow you down. Terry, I know Terry has a question back there, and we're giving out a ton of information. Terry, go ahead.
Yes, two questions that come to mind, Rick. First of all, can you tell me, I think you told me when you and I spoke a couple of weeks ago that the interest rate is fixed. Can you tell me what that rate is? And does it stay fixed for the life of the loan? And then also, if you do a purchase with a reverse mortgage, typically what's your loan to value? How much do you have to come in with? If you can address that, please.
Yeah, absolutely. Well, actually, the fixed rate is the minority of the option chosen. And in fact, when reverse mortgages first were created, there was only one option, and that was a monthly adjustable interest rate. Why was that? Well, because there was the feature of the line of credit. And like most products that offer like a line of credit, most of those types of financial products work off adjustable rates. Why? Because if I have a line of credit that I'm making available to you and you're going to borrow from me over time, you've got to also ride the interest rate with me as a creditor if I'm going to keep lending you money or giving you the ability to lend money over time, right? Now, in 2009, 10, the product came out with a fixed rate. And it was really just to give the consumer one more option. However, it really never took off. Reason being is for two. Number one, what you qualify for under an adjustable rate reverse mortgage is much greater than what you qualify under a fixed rate. And that's getting into loan to value percentages or down payment percentages, right? So number one, if I'm a consumer, I'm looking at which product is going to save me the most liquidity or going to allow me to grow more liquidity, and that is the adjustable rate product each and every time. And then secondly, because fixed rate loans are known as close-ended loans, and you cannot continue borrowing after the close, like I was explaining a second ago, you do not have what I call the secret weapon with the fixed rate, and that is the growing line of credit and everything that option provides one for the retirement. So because you don't have that option under the fixed rate, this is why the fixed rate product is not chosen as much as the adjustable. So again, it's a rewiring on how one looks at real estate and mortgages with this product, and it's also a rewiring of how one looks at interest rates, whether it be adjustable or fixed, because the way we were taught on traditional mortgages is try to focus on a low fixed rate. Why? Well, If you get an adjustable rate with a traditional mortgage and those rates go up, that means your mortgage payment goes up with it. And that's been the big stigma of the adjustable rate mortgage in the mortgage industry. But with this product, there is no payment. So therefore, you do not have that payment shock or that factor that's in it. The second question, to give everyone an idea, if you're going to use a reverse mortgage to buy a home under the home equity conversion mortgage, the FHA reverse mortgage, right now, on average, the down payment percentage is roughly 60%. And that's for a consumer in their early 60s. Now, why is that a factor? Well, what a person qualifies for under this product is not the same for everybody. There's two factors. Number one is one's age. The entry-level age is 62. But the older you are, every year that you're older, you qualify for a little bit more. So someone who's 72 qualifies for more than a 62-year-old, and someone who's 82 qualifies for more than a 72 or 62-year-old. And when you're buying a house, the older you are, the less you have to put down as a down payment as well. So it's not a one-size-fits-all. Also, credit scores are not a factor with this product as well. You know, we've been taught forever that, hey, the better the credit score, the better the interest rate, or the better loan to value terms. That is non-existent with this product. FICO score is completely irrelevant when it comes to a reverse mortgage. So age is a factor. And then, of course, the other factor is interest rates. The higher the interest rate, the less you qualify. The lower the interest rate, the more you qualify, or the less you have to put down. But 60% is a good kind of walking around number right now. Now, keep in mind, interest rates come down later this year, whenever that's going to be, then that 60% could now become 50% down. You know, so it's not a stagnant figure, that loan to value percentage.
Can you tell us what determines the interest rate? Is it prime plus something?
It's the 1-year constant maturity treasury plus the margin. So if you look at that index, the 1-year CMT, that is the index that's chosen not by banks, but by the federal government. They're the ones who dictate the index on this product. Prior to that, we were on the 1-year LIBOR, and we were on that index for about 10 years. And now we went back to the CMT. The CMT was prior to the 1-year LIBOR. So the federal government, since I've been doing this, we only have had 2 indices that we've had in the last 20 years, the 1-year CMT, the 1-year LIBOR. So it shows that the federal government is also always mindful with this product, at least, in trying to find an indice that's one of the least volatile indices out there for, you know, this demographic of Americans.
I'm sorry, is it the CMT plus something, I assume?
Yeah, it's the 1-year CMT, then plus a lender margin. And those margins right now could be about anywhere from 2 to 2.5%, depending on the lender.
All right, so if I look at the 1-year CMT,
while he's looking that up, Rick, you said that somebody can actually go buy a house and possibly put 55% down and never ever have to make a payment for the rest of their life.
Yeah, I mean, that's pretty exciting, right? I mean, and like I said, that's a whole other presentation, but this is what we call the H for P, which stands for the HECM for purchase, acronym within an acronym. HECM stands for the home equity conversion mortgage. So all sorts of reasons why that can make a lot of sense. I mean, number one, stats show most people in retirement, when they go to buy a home, they want to pay cash for the obvious reason that they don't want to reset the clock with another mortgage payment for the next 30 years. In other words, making a mortgage payment to the day you die. And I agree with that 100%. Why are we resetting people into 30-year mortgages when they're in retirement? There's not many situations where that makes sense. So stats show most people are going to pay cash. Now, where's that cash coming from? One of 2 places. It's either A, coming from the net gain of their existing housing wealth, home that they just sold, and they're just rolling all that into the next house, or a large portion of that. And or B, some of them are going to their financial advisors and pulling money out of their investments to make this purchase. Now, one advantage of using this product is that because it's an optional payment mortgage, that takes away that factor for many seniors. That is, I don't want to make a mortgage payment for the rest of my life. Why am I going to do that? So that aligns with that objective. And then secondly is that the way you can leverage this tool against your current housing wealth or your current cash assets, in which, as we just discussed, depending on your age, you might only have to put a one-time 60% payment, and that is it for the rest of your life. Therefore, the other 40% that you were going to dump into real estate, which was just going to stay stagnant in real estate, number one, was going to be illiquid, because that's what happens when you take cash, which is a liquid asset, and you put it into real estate. Now it's become illiquid. You can't take the money back out. So in this scenario, this is just one case study of many. You use this product to purchase the home, you retain that 40% of cash liquidity, and now you give that to your financial advisor. You have him or her putting that to work in your nest egg. Or maybe you go buy another piece of property, another investment property, all different types of then options that one has, because you've remained more liquid than putting it all into real estate. And and that's big when you're in retirement. If this is going to be your forever home, okay, and these are the questions that we go through before we even start with anyone. I want to know everything about the objectives. I want to know, this house that you're looking to buy, is this your forever home? I want to know about your beneficiaries. But if this indeed is going to be your forever home, and you're in your 60s or 70s, you're in your retirement, this is where I'd like people to pause and think about, why am I putting all my cash into real estate at this juncture in my life? Why don't I keep some of that liquid? I mean, what happens if real estate crashes like it does from time to time, or you have, depending where you live, what part of the country, you have a natural disaster like what happened in the Gulf of Florida with Hurricane Ian not too long ago. And there was an article from political.com that said that many of those people who paid cash in that area, not only did they lose their homes, but many of them, their entire nest egg wiped out, because the majority of their wealth was in real estate. Those homes up and down that area of Naples and Marco Island, homes of 1 million, 2 million plus, people from California, New York that paid cash for those homes, thinking that that was the best option. And they lost the home. They lost all the money. They're not going to be able to gain it back, because flood insurance only covers up to a certain amount, 250,000 or so. And the article said that unfortunately these people in retirement, because now when you're retirement, your window to recover from catastrophes is so much smaller that they're wiped out. They're not getting that back in their lifetime. And the article said, it's not a reverse mortgage industry article by any means. It said that if more of those people would actually taken out a reverse mortgage, they would have been able to retain a large amount of their liquidity, 40, 50%, and that money would still be sitting in the bank today. That's just one example of how this can be used.
I'm really glad that you gave an example and you shared a story, because that's what our whole group is, our membership base. When you're on in Leaving California, Life After California, you hear story after story. So for the people that are watching, I'd like for you to maybe try to turn a little bit into them. We have 300,000 members that are thinking of leaving California for whatever reason. And, they're thinking about leaving California, maybe going to Dallas, going to Nashville, going to a different place. What would you say to our members on how this what could affect them? Give some examples. I know you already have, but let's make it more specific to the group.
Sure. Well, again, if the objective is to relocate another primary residence, because by the way, this product is only for primary residences, not for second homes or vacation properties. So if that's the case, they're going to go, as you said, Nashville, other parts, and they're looking to determine how they're going to finance this purchase. I would say you got three options. You're either going to pay cash, you're going to get a conventional mortgage, you're going to put 20% down. That's attractive. The unattractive part is the 30-year payment and the interest, the amount of money that's going to come out of your pocket in your retirement over the next 20, 30 years, however long that is, or you have a reverse mortgage for purchase. And I would certainly encourage you to look at all three options, see which one makes the most sense. What the research has shown from this is that and common sense in a lot of ways is that when you have more access to liquidity, more options are going to present themselves to you, and it's going to allow you to better strategize what is best for my retirement. And when I've been asked, Rick, give me the one-liner, what will this do? What will this product do for me? One-liner, and that is, it will take what you have today in terms of your nest egg, whatever that is, and that'll help it stretch it out further so that you have more money to last you a longer period of time. So to your viewers out there, if that resonates with them, if they have a concern today that they don't have as much money as they think they should have to last them the rest of their life, and they're looking to make a big purchase with real estate, that's where I would caution to pause and look at this option to potentially help them have more money to last them a longer period of time. If that's their goal, like many of us, I think that, in fact, I'm going to go out and be bold and say, I think the majority of us, that is our goal, is that we're trying to find out, we're all out here hustling and trying to get through life to try to figure out how we can surmount as much assets as we can to avoid running out of money before we die. I mean, that's the biggest fear aside from dying for most of us, is running out of money before we die. And how are we going to accomplish that? And this product and the research that's been back on this product has demonstrated that in many, many cases, this is exactly what this product will help one avoid, running out of money.
Hey, Rick, one of the things you mentioned is savings in income tax. Can you address that? And of course, we're all used to writing off the interest of our traditional mortgage. How does it work with reverse mortgage?
So with a reverse mortgage, you can't, or a mortgage interest deduction doesn't become available until you actually exchange cash, right? Because it's cash basis accounting. So if you're not making any payments, your balance is accruing, but that accrual, you can't write that off until you actually make payment. So for many Americans, mortgage interest has become what's known as the loss deduction. There's been articles written about this, that, for so many of us, when we bought homes, a big part of that motivation was, hey, this is going to be great for my income taxes. I'm going to be able to get this mortgage interest write-off. But many Americans today, especially those who got these post-pandemic 2% interest rates, many of them are not, their itemized deductions are nowhere near the standard deduction. So therefore, they're not even experiencing a mortgage interest write-off. With this product, because you are able to make a payment for whatever you want, whenever you want, I personally have had many clients, and the industry has had many clients who now, this is part of the strategies, now can strategize and, for example, maybe make one large payment towards their mortgage every so often. Maybe it's not even an annual basis. Maybe it could be every couple of years. As an example, I make a large payment towards my reverse mortgage. And because this is not amortized principal and interest, it's all interest plus a small amount of insurance that's being accrued on the balance every day. That means that the majority of my payment that I make every month, or whenever I make a payment, again, it doesn't have to be every month, is going to be applied towards mortgage interest. So now I'm, again, going back to the control. And one of the many reasons I love this product, I have control over my money. I have control over my mortgage and how I want to manage it. And in this situation, how I want to manage my mortgage interest deductions. And maybe I want to create a mortgage interest deduction for myself every couple of years, not to get too deep. But for example, I have clients who are now at the age where they have to take required minimum distributions from their investments. And they don't necessarily want to, but they have to. And when they do, they have to pay income taxes. So I've had some clients, they don't need the money from their RMD, so they'll take the RMD payment, say it's $30,000, and they'll pay $30,000 towards a reverse mortgage. And get a load of this, three things happen. Number one, that $30,000 payment goes against the debt. So now my reverse mortgage balance goes down by 30,000. That's step one. Step two is, because of that, now it's created a mortgage interest deduction of approximately 30,000. So I'm going to get a 1099 at the end of the year that's going to show I made a 30,000 thereabouts mortgage interest payment. The next step is that, and this goes back to the line of credit and why the adjustable rate is the majority of the transactions that are put together because of this tool. Now, the next step is that $30,000 payment I made, every dollar of every payment that I make towards a reverse mortgage goes into my line of credit. So now the next step is that now my line of credit availability has been increased by 30,000. Okay. Which, if I pause there for a second, this is where I think this product is so superior than any of the mortgage. Even for people who have a 2.5 interest rate who say, Rick, I have a 2.5 interest rate. I'm never going to let that go for the rest of my life because rates are never going to get that low. And my payment is so low. Why would I do this? Well, the reason you would do this is because you're making payments right now and that money's vanishing. 1,000, whatever the payment is, you make a payment today, you send it to the mortgage company, and poof, the money's gone. When you make a payment to a reverse mortgage, every dollar of every payment goes into this line of credit. It posts in 3 days. And if you want to take that money back out, you can take that money right back out without any questions asked. So number one, you remain liquid. And I can't stress that enough. This is what retirement experts talk about all the time in retirement, which is liquidity, liquidity, liquidity. So going back to my example, I now am liquid still 30,000. That's sitting in my line of credit. And then the last step, that 30,000 is growing by the exact same interest rate as my loan balance. Right now, to give you an idea, interest rate somewhere between 7.5%. My 30,000 is growing within my product by 7 to 7.5%, which then gives me the ability to have more access to liquidity over time through my reverse mortgage.
That's great.
Wow, this has been so much information. And Rick, you're right. We could have done this class probably 3 or 4 hours long. And I appreciate everybody listening and tuning in. And there are a lot of people that are concerned about this. But if we switch gears a little bit, I think I shared this with you when I met you about a month ago. I moved here in 1975. I'm a little older than you are. What year were you born? How long have you been here?
Well, since I was born, which was 2 years after you got here, 77.
Okay, so if you could share with some of our members, just for fun, just why Las Vegas? And we posted something about 2 months ago, and I remember we were getting a lot of hate mail. A lot of people, imagine that, Terry, somebody saying something negative in our on our groups.
Oh, I'm glad I'm sitting down.
They said, Rick, they said that why would anybody want to live in a desert? Las Vegas, it doesn't have any water. They're going to run out of water. Why would you live there? Or the biggest one we get, of course, is, oh my God, it's just way too hot. We have some of the best weather 6 months out of the year, just like Terry does down there in Florida. But if you don't mind, I know we're getting close to the top of the hour. If you could just share a little bit about somebody that was leaving California and why Southern Nevada.
Yeah. Well, I can tell you, I mean, I can't speak much about the water rights, but I mean, I think we're in a better position than maybe most in California. I mean, the water rights are just, much of an impact in California and Arizona as they are in Nevada. That's a whole other topic of conversation that, hopefully those who are in charge, we're making better strides. And, we got a lot of great rain here in our area and through the Colorado, and so hopefully the mountains up there are gonna, once the snow starts melting, we're gonna see some increases at Lake Mead. So, that's just Mother Nature doing what Mother Nature does. We have no control over that, number one. Number two, I can tell you this, that being born and raised here in the 80s, and what I look around now, raising my own family here, this town has become more community oriented than when I was a kid in terms of what's available for families to do. It's no longer just a town of hotels. We've got a diverse industry of businesses. We've got a diverse industry of more cultural community or cultural choices and things that I never had as a kid. You know, going to a theater, or the Smith Theater we have here, seeing plays, operas, that kind of, none of that existed. So my point is that this town is really rounding out to be much more than just a desert tourist town catering just to the casinos. Weather, listen, like anything, our bad winter storm is the heat, but you can escape the heat. You don't have to deal with shoveling heat, or having the heat really get into your day to day. You've got air conditioner in the car, you got air conditioner in the house, and everywhere you go. I mean, that doesn't bother me either. So I wouldn't let the weather be something that would keep people from looking at this town. We got a lot of great upsides. No state income tax. We know that property taxes are relatively low comparative to most places. Same with homeowners insurance. So a lot of upsides, in my opinion, to living here in Vegas, and its proximity. Those that are coming from California, you still, we're 4 hours away from the beach here.
Yeah.
4 hour drive from Las Vegas to Southern California. So proximity wise, you're still close to the coast. And if you like the outdoors, lots of outdoor activities, hiking and those types of things. So yeah, I think it's a great place. And we know that for retirees, it's in the top 10 of cities in the country. And we vacillated many times, number one, number two, for the top city for people in retirement to move to, for reasons I mentioned, and a lot more reasons as well on top of it.
So this was episode 23, Terry, and man, so much information to unravel. And I imagine some of our members may watch this back a couple of times, because we really hit a lot of things. And I don't know if I missed anything that was on your mind, Terry. Did I miss anything that you were thinking?
I don't think so. I would love for people to, Rick, to give your contact information. And boy, I'll tell you, you've certainly opened my eyes. And again, my information was 20 years old, as you alluded to, that the reverse mortgage has changed a lot. And I will tell you, I'm going to buy a place here in Florida. I'm looking to move away from where I am because it's getting a little too liberal for me. So when I buy a house, I may strongly consider a reverse mortgage, because, I don't mind having access to cash reserves, and letting that, my heirs will do fine. They don't need me to leave them my house. They'll do fine without me. So anyway, I would love to have your contact information, Rick.
Yeah, absolutely. I've got a screen here. I don't know if I can share a screen, Mike, if that'd be easier for the viewers.
Sure, yeah, that'd be fine.
Contact information.
Go ahead.
Go ahead. Sure thing. Let me give me 1 second here to maneuver.
And by the way, if you're looking for Las Vegas, I'll share my contact. It's 702-374-1771. And my email is lasvegas@davidberry, BERRY, realtor.com. And look at how high tech Rick is. He's got his whole business card right there. Go ahead and let everybody know how they can get a hold of you.
Yeah, absolutely. So my personal number, which I actually answer, you can call me at 702-460-6222. You can also text me to that number. My personal email address is Rick, RICK, .Rodriguez. That's RODRIGUEZ at Fairway MCMaryCharlie.com. And you can also visit my website, which is theretirementhomeloan.com. And you can get more information about myself, contact information, and learn a lot more about this product as well.
Hey, Rick, real quick, can you do reverse mortgages anywhere?
So our company is licensed in all 50 states. And my staff, my team, we're licensed in over 10 states at the moment.
Great. Great. By the way, thanks for not putting your high school picture on there like realtors tend to do.
You're welcome. You're welcome.
All right, everybody. Thank you guys for tuning in. If you have any questions, please let us know. We're here to help. and we will talk to you soon. Have a great day. Bye-bye.
Thank you, gentlemen.